Today, we're diving into a crucial metric that every investor should know about: the cap rate. If you're new to the game or looking to refine your real estate investment skills, stick around as we break down the cap rate and explore why it's a game changer in the world of property investment.
Disclaimer: I am not a CPA, attorney, insurance, contractor, lender, or financial advisor. The content in these videos shall not be construed as tax, legal, insurance, construction, engineering, health and safety, electrical, financial advice, or other, and may be outdated or inaccurate. It is your responsibility to verify all information yourself. This is a YouTube video for entertainment and educational purposes only.
Okay, let's break it down. Imagine you're thinking about buying a duplex. The capitalization rate, or cap rate, is like a tool that helps you figure out how much money you might make from that duplex. To find the cap rate, you look at how much profit the duplex is expected to make. We call it net operating income, or NOI. And then you divide that by how much the house is worth. Purchased value. The answer is given as a percentage, but in order to get the percentage you need to multiply the decimal unit by 100. This percentage helps you understand how good of an investment the house might be. The cap rate is handy because it lets you quickly compare different houses to see which one might be a better deal. But here's the catch: you shouldn't decide to buy a duplex just based on the cap rate. Why? Because the cap rate doesn't think about some really important things like loans you might take. We call it leverage. The fact that money today is worth more than money tomorrow. We call it the time value of money, and money you might get from improving the house later on. So, while the cap rate is a helpful tool, it's not the only thing to look at when deciding if a duplex is a good investment or not. There are other important things to consider too. Alright, imagine you're thinking about buying 2 candy stores, and you want to figure out which one might make you more money. This is where the cap rate can help. Candy store costs $100,000 and it makes $10,000 in profit every year. To find the cap rate, you divide the profit $10,000 by the cost of the store $100,000 and then multiply by 100 to get a percentage. In this case, the cap rate is 10% because $10,000 divided by $100,000 multiplied by 100 equals 10%. Now, let's look at candy store B. It also costs $100,000, but it makes $15,000 in profit every year. To find its cap rate, you do the same thing. $15,000 divided by $100,000 multiplied by 100 equals 15%. So Candy Store B has a higher cap rate, which is 15%, compared to Candy Store at 10%. This means, based on the cap rate alone, Candy Store B might be a better investment because it has a higher expected rate of return. But here's the catch: the cap rate doesn't tell us everything. Maybe Candy Store A is in a super busy area, and even though it has a lower cap rate, it could end up making more money because it's in a better location. So, while the cap rate is a good starting point for comparing investments, you have to look at other factors, like where the stores are located and if they might become more popular in the future. Make sure to subscribe to learn more about real estate and turn on the notification bell to be alerted to new videos. Make a comment on what I missed or what you enjoyed about the video. Also, like the video if you enjoy or learn something new about cap rate, and share this to your friends or family members. Also, make sure you are staying on your track to build wealth, and have a blessed day.